Hello, my name is Steve LaRosa, and I am a Director and Portfolio Manager at Edgemoor. For my section, I am going to discuss two investments that we at Edgemoor own and are currently buying for clients. One is an equity investment, where the objective is capital appreciation, and the other is an income investment, where the objective is to generate current income as well as price stability in a portfolio. Both of these companies are good examples of the quality investments that we're able to find for our clients as a result of our thorough research and long-term investment horizon. The first company I want to discuss is United Rentals, or URI, which is the largest construction equipment rental company in the U.S. United Rentals has a diverse offering of nearly 5,000 classes of rental equipment, everything from trucks and forklifts and aerial platform equipment to portable storage and modular offices and lighting equipment. These items can be rented from URI on a monthly, weekly, daily, or even hourly basis. United Rentals has the most expansive branch network in North America, as detailed here on this slide. The U.S. makes up about 90% of their revenues, so this is a very domestically focused company. URI has grown to become the market share leader in what is still a very fragmented industry with dozens of smaller local competitors. However, we believe that United Rentals' size and scale afford the company numerous competitive advantages, including a large and diverse rental fleet, significant purchasing power, and operating efficiencies. These advantages translate into a wide economic moat for their business, which is a key attribute for our equity investments. URI is one of the only companies that has the flexibility to provide the right equipment at the right place and time for their customers, which range from Fortune 500 companies down to local construction companies. In addition to their economic moat, United Rentals has and should continue to capitalize on several secular growth trends. The first and perhaps most powerful trend is the ongoing shift of renting these type of equipment rather than owning it. Renting has several clear benefits that their customers are increasingly realizing. First, it conserves capital for their customers, which is important. Second, it reduces the equipment's downtime. Construction projects are very fluid, and if a crew only needs a certain forklift for a couple days or even just a few hours, then it makes much more sense just to rent it from URI instead of buying and owning it. Third, renting equipment also results in less inventory for the customer, which means they don't have to hold it on their balance sheet. And finally, renting reduces ongoing costs such as maintenance, storage, and transportation. Another tailwind for the company's growth are the various federal infrastructure programs that have been enacted over the past several years, many of which have already begun or are just ramping up. In addition, the trend of reshoring, or bringing manufacturing activity back to America's home soil, is a positive for URI. Increasingly, new production plants and facilities are being constructed domestically as opposed to overseas, boosting construction activity and the need for more equipment. And finally, increasing new investments in areas such as clean energy and the modernization of the electric vehicle industry are just a couple more examples of growth opportunities in construction that United Rentals should continue to benefit from as well. And now I want to look back at the company's impressive track record for a minute. Over the past 10 years, URI's revenue has grown north of 11% per year, as they have executed and already begun to capitalize on many of those growth trends I previously mentioned. And as the company has gotten bigger, their management team has also done an amazing job of increasing their profitability levels and margins. The result has been an even higher growth in their earnings per share, which has grown 25% on an average annual basis over the past 10 years. Edgemoor began purchasing United Rentals stock for our clients back in May of 2015. At the time, the stock was trading at a multiple of around 10 to 11 times forward estimated earnings, yet the company was well run and had good growth prospects. The stock's multiple was depressed at that time due in large part to its higher exposure in the oil and gas industry. However, the company was making proactive strides in diversifying their customer revenue mix, which they were ultimately successful with. Here, Edgemoor's long-term time horizon served us well once again. Since our original purchase, URI stock has generated a compound annual growth rate of about 25% per year, nearly doubling the return of the S&P 500 index over the same time frame. In addition, the stock has generated average annual returns above 30% annually for the past 3 years and 5-year time periods each, which is an amazing track record. Given this strong performance, URI's forward price-to-earnings multiple has increased over time. However, it still trades at a discount to the S&P 500 index. In addition, over the last several years, the company has done an impressive job of increasing the free cash flow that they generate, which is a positive for us as stockholders. At the same time, they have also decreased their debt and leverage ratios, as well as steadily increased overall corporate margins and returns on invested capital. The company's board also initiated a dividend in January of 2023, and since then have already increased it by 10%. They are also very active in buying back their shares consistently. We expect that these attributes, along with the company's strong competitive advantages and growth prospects, should allow the stock to continue to generate attractive returns for our clients over the long term. United Rentals is a good example of the type of equity investment we own for our clients at Edgemoor, and it is currently one of our larger holdings at the firm as well. And now I will shift the focus and discuss an income investment that we own at Edgemoor, and that is American Electric Power, or AEP. AEP is a purely regulated utility company that operates the nation's largest electricity transmission system, as well as 225,000 miles of distribution lines that safely deliver reliable and affordable power to customers across 11 states. And specifically, AEP has a strong operating presence in faster-growing states such as Texas, Ohio, Indiana, and Virginia. These are states where the demand for industrial power generation is increasingly rapidly, driven by the explosive growth in data centers and artificial intelligence computing, which require an enormous amount of power to operate. This slide here shows the outside of a data center in Ohio on the left, and then the inside of one on the right. The growth in demand from this area should help support AEP's nearly 4% dividend yield. AEP generates its power from several diverse sources and expects that 45% of its power generation will come from renewables such as wind, solar, and hydrogen by 2034, up from roughly 21% today. As a result of that increase in renewable power, the company is on track to reduce their carbon dioxide emissions by 80% by 2030 and has committed to achieve net zero emissions by 2045. On their most recent earnings call just a few weeks ago, AEP unveiled an updated 5-year plan where they committed to invest $54 billion of capital from 2025 through 2029 in order to grow their operations and renewables business, and also to help meet the significant increase in demand for power in our country, driven by those new data centers and AI spending that I mentioned earlier. This new capital plan will also help to expand and improve our country's electric grid, which is long overdue for an update. It is important to note that all of those capital investments are allocated to regulated businesses and contracted renewables, which means that this plan should result in a steady and predictable increase in AEP's rate base, revenues, and earnings. As a result of this new plan, AEP increased their earnings growth forecast to a range of 6 to 8% per year over the long term. In order to achieve that level of growth, the company will need to execute operationally. To that end, the company recently hired a new CEO, Bill Fairman, who has spent his entire career in the utility and energy business, most recently as the head of the highly respected Berkshire Hathaway Energy division. We believe he has the right background for this company in the current environment in order to help them execute on this new plan. I also want to reiterate one of the main reasons we own AEP, which is their dividend and the growth in that dividend. This slide here illustrates the fact that consistent and steady increases in their dividend have been a hallmark for this company. Over the past 10 years, AEP has increased its dividend from $2.03 per share up to $3.57 per share in 2024, which equates to about a 76% cumulative increase. The company is also now forecasting 10 to 12% in total shareholder returns annually over the long term, which is comprised of their 4% dividend yield plus their 6 to 8% long-term earnings growth rate. Putting this all together, AEP is expected to benefit from the massive growth in data centers and artificial intelligence spending. Their new capital plan will help modernize and update our electric grid. And in the meantime, as shareholders, we receive a solid and growing dividend. AEP stock also exhibits defensive characteristics with lower volatility than the overall market. And its valuation is relatively attractive, as their stock currently trades at around 16 times on a forward price to earnings basis, which is below its 5-year historical average of 17.4 times. These attributes make AEP a great example of an income investment we own for our clients at Edgemoor. Thank you for listening.